So this is just a brief overview of T-bill pricing yields for Treasury bills. Treasury bills are short-term government securities issued by the U.S. government. Other countries also issue treasuries. They're different securities, but it's just that they're also called treasuries. But basically, they're government-issued bonds, and treasury bills are government-issued bonds that have short-term times to expiration. And so, like all bonds, treasury bills have a face value, the sort of worth, the amount that gets paid back at the time of maturity for the bond, which doesn't necessarily equate to the price of the bond itself. The price of the treasury may not be equal to the face value of the bond, maybe something higher or lower, depending on whatever interest rates are doing at that time of sale. And that's what really drives treasury bill prices, is not so much default risk of the government. The likelihood that the U.S. at least defaults is quite low over a very short horizon of, say, 3 to 6 months. So what drives treasury bills instead, rather, is whatever's going on in the market for U.S. interest rates. So you see a lot of topics, a lot of discussion about whatever interest rates are doing, what the Fed is doing in terms of influencing interest rates. All that talk really has a big impact on the prices investors are willing to pay for treasury bills. And the way treasury bills in particular work is kind of unique. For very short-term treasury bills like this, you see 3 to 6 months, they don't actually pay a coupon. And instead, what happens is they get sold at a discount. And so, for example, you see here, both of these treasury bills have a face value of $10,000. An investor who buys one of these ultimately gets $10,000 back. And the way they get income or yield is that effectively they get that because they buy these at a discount. And so instead of paying $10,000 to get $10,000 back 3 months later, which doesn't sound like a great deal, this investor might pay $9,994 today, and then 3 months later get back $10,000. So they're making a $5.75 profit or income, if you will, on this 3-month government security. And then likewise for the 6 month, they're going to make, if they purchase at this 9977 price, $22.90. And so if we take these dollar profits and kind of look at it in terms of yield, and let's call it simple yield because we're not doing any annualization or anything like that, we can get the yield by taking the income earned and dividing it by the price that they paid. And for a 3-month purchaser of this bill, they get 0.0575%. So basically 5 basis points. It's a very tiny yield, but it's that's what they're getting on a 3-month basis. And so we might look at this instead of looking at a simple yield. We might annualize this to get a different perspective. And the way that we're going to do that is to compound it. So we're going to take the same thing that we've got above here, the income earned divided by the price paid. And this is the income earned over 3 months. And so on an annualized basis, we can take 3 months, 90 days, take 360 over 90, and subtract 1 from all that to get 0.23% or about 1/4% for an annualized yield for short-term government securities. So U.S. Treasuries, especially short-term, treasuries often offer these extremely small annualized yields. You actually see that the real yield of this is negative. I mean, if you take inflation, which at the time of this recording is somewhere on the order of 7%, the real annualized yield of a short-term treasury right now is deeply negative. But that's both typical of short-term treasury yields. They tend to be extremely low, but also atypical in the sense that there's usually not so drastic a difference between inflation and U.S. treasuries. And so if this is the simple and annualized yield for the 3-month treasury, we basically can do the same thing, really exactly the same thing, but with the 6-month prices, and take the income earned from investing from buying this bond divided by the price paid for this one. Or if we are taking an annualized version of that, one plus that same amount, but then with the difference is that since we're compounding, and it's over 180 days instead of 90 days, gets us our annualized and simple numbers respectively. And you can check your numbers here. You can see the annualized yield here for the 6-month treasury is still quite low, about 0.5%. Annualized, that means we can compare these two numbers. They're on an apples to apples sort of footing. We see that the 6-month is higher than the 3-month. And that just means that an investor is getting a little bit extra of a premium for locking up their money for an additional 3 months over and above a 3-month bill. It's like when you go to a bank and you look at certificates of deposits, you get a higher interest rate if you lock up your money for longer with the bank. Same idea that you see happening here. And there's one more thing I wanted to mention with Treasury bill yield pricing, and that's just the distinction between Treasury bill yields and futures pricing on treasuries. So here, the simple yield, for example, the way we're getting it is we're taking the face value and subtracting the price that we pay. And then we, divide it by the price that we pay to get a percentage rate. But this simple yield is like the interest that we actually get for 3 months for this 3-month treasury bill. And if we want to annualize it, then we do this business here and then we get this number here. But that's when we're looking at treasury bill yields. And I just wanted to make the distinction. If you see, for example, in your homework where you see treasury futures contracts, futures on treasuries are priced a little bit differently. They are already annualized. So you take 100 minus the futures price that you see, whatever that is, and the result that you get is already annualized. So it's on an annual basis. And then I just want to make that distinction because that's a little bit different. What you see in futures is a little bit different than when you're looking at raw treasury bill yields or prices by themselves.